Welcome back to the channel. To my returning subscribers, I say welcome. And if you're new here, thank you for joining us. And today we're diving straight into 4 pillars that every Forex trader needs to master, which are lot sizing, leverage, win rate, and risk management. Mind you, these aren't just buzzwords, these are your survival kits in the Forex market. So if you're serious about becoming consistently profitable, stick around to the end. Right, so we'll start with the first one, lot sizing. Right, lot sizes. And what exactly are lot sizing? It's simply how much you are trading per positions, right? Your lot size determines how much each pip move is worth. And if you get this wrong, and even a small move against you can wipe out your account. So primarily we have 3 types of lot sizes, or 3 categories if you would say. We have the micro lot, the mini lot, and the standard lot. And the micro lot always ranges from 0.01 to 0.09, which in dollar value is just about $0.1 or 10 cents to $0.9 or 90 cents for the micro lot, while the mini lot is $1 per pip to about $9.9 per pip. And for the standard lot, it is $10 per pip to as much as it can go, depending on the brokerage or platform you are trading, right? So how exactly do we calculate lot size? Well, it's basically based on how much you are willing to risk per trade, which brings us straight into risk management, right? And I know all of these things when we go into practical examples, it will make more sense, right? So what is risk management fundamentally? Risk management is about controlling your losses, not avoiding them. Risk management, really, you're just managing our risk, right? And of course, a solid rule of thumb would always be that you should risk between 1 to 2% of your account size on a single trade, right? And for the sake of this video, just as I've written down here, I'll be explaining with prop firms, because for me, prop firms just really bridge the gaps of capital and also risk to reward so well. So for the sake of this example, I'm using a $10,000 account, right? I'm using a $10,000 account. So when I say there's a rule of thumb to risk between 1 to 2%, doesn't mean you should vary your risk between 1 to 2% depending on how you feel. I would always advise to pick a fixed risk. So if I thought you want to go with 1%, you want to go with 2%, or you want to go in between, depending on your higher. Because some people have higher risk appetite, right? And that tends to be advantageous sometimes when you know what you're doing. But for me, personally, I use 1.5% risk per trade for my prop firm account. So on a $10,000 account, that means I'll be risking $150 per trade every time, right? So that gives me a fixed risk. So I know that whatever setup I see, I'm risking $150. So what will now determine the lot size I'm going to use would be my stop loss in pips, right? So for example, if I were seeing a setup of 50 pips, right? So if I see a setup of 50 pips, automatically I already know, because my risk is fixed, right? I have a fixed risk of $150, right? I have a fixed risk of $150. What that means is I can only use a lot size that would permit me to lose $150 on that 50 pips setup. And what would that be? To always get your lot size to use, you divide your fixed risk in dollar value by the number of pips. And in this case, we are risking 150 pips, so we divide by 50. What would that give us? 3, right? And if we go back to our lot size, we would see that $3 per pips fall in between the range of the mini lots. So technically, this would mean that on that setup, I would be using a 0.30 lot size, right? A 0.30 lot size. Alternatively, if my setup were giving me maybe 100 pips stop loss, right? The same formula still applies. I divide the $150 fixed risk by the 100 stop loss in pips. That gives me what? 1.5, right? So what do I use in that case? 1.5 means $1.50. So in that case, the lot size I'll be using would be a 0.15 lot size, because 0.05 depicts 50 cents while the 0.1 depicts $1, right? So I'll be using a 0.15 lot size, because what is always fixed will be my risk in dollar value, but my lot size won't be fixed, right? But whatever and however the trade goes, right, I won't lose more than 150, and that's why it is always very important to know what lot sizes are and applying it with risk management. Now you see how the two of them are connected, right? Fine, that's good. And also, I would just like to touch on leverage, because the truth is, when you are even very big or keen about risk management, leverage becomes something that you're just aware of, right? Because you don't over leverage or over risk, right? So now leverage just talks about the backing the broker gives you. Some brokers love offering between 1:500 to about 1:1000, right? Sounds great, right? But here's the truth: leverage really amplifies your gains or losses. Using high leverage with poor risk management is like driving a Ferrari with no brakes, and what would be the end of that? You would always crash, right? And even if you even see a potential hurdle in front, there's no way you can mitigate that risk, right? So one of the golden rules is to always know where your stops should be before taking any trade. I mean, before you even press a buy or click the sell button, you should already know that, okay, at what level do I want to get out of this trade, or how much am I actually willing to risk on this trade. That alone would inform you that, okay, whatever's going to happen, this is the worst case scenario. And trading has to be something especially the things you want to do, should be known before you take the trade, or else your emotions will just be all over the place. And I'm going to post a separate video for emotions particularly, but we'll talk about that in a video. And if you're loving this content so far, the information so far, please hit the like button and the subscribe button to get more insights and educational tips like this, right? Okay, so that's all I'm going to touch on about leverage, right? So let's go on to the next and the bread and butter of this, which is the win rate and risk to reward ratio, right? And just as I pinned down here, you don't need to win every trade to be profitable, and in truth, you won't even win every trade to be profitable. Like I said in one of my recent videos or previous videos, I said there are only 4 outcomes in trading, right? We have the big wins, the big losses, the small wins, and the small losses. And we always need to keep those big losses out of reach. Like, those are the killers. We need to keep them out of reach. So managing our risk to reward, knowing your win rates, managing your risk, using appropriate risk and lot size will always keep you in the game for the longer haul, right? If your risk to reward is 1:2, and I'm using this as just a bare minimum, at least you're risking 1 to make double, right? Which is sensible. Different people have different win rates. I mean, depending on how your strategy is, you can work it all out. But this is just a structure for something that for you to tailor your system with, right? So even if you have a 1:2 win rate, meaning anytime you risk $150, in my case, I'm looking to make $300, and on the prop account, that's 3%, right? And we all know that all props have targets, so maybe the phase 1 ranges between 8 to 10%. So a winning trade gives me 3%. So I know an average of 3 to 4 trades in wins can give me the target I'm looking for, right? So based on that, I know that, okay, fine, I have a risk reward ratio of 1:2, and I'm trading with a 50% system, right? What would that give me? I know that after every 10 trades, right, every 10 trade sample, I expect to have an even distribution of wins and losses. Doesn't mean that per trade I have a 50% chance of winning, no. But what it means is after a sample size of 10 to 20 trades, I should be having an even balance or an even spread of wins to losses. So that gives me confidence to just keep trading my system because it has been back tested and I understand my win rates and my risk to reward. So on a 10 trade sample size, I expect to make 50% wins, 50% losses. So that will be about 5 wins, which risking 1.5% per trade to make times 2, so that will be 3% in profit, right, multiplied by 5, and that will be 15% in profit for the wins, whereas the 5 losses would be me losing 1.5%. Why am I making these mistakes? 1.5%, right, and I lose that 5 times, right? So that would be 7.5% in losses, right? Sorry, I'm gonna brighten up that now, right? So that would be 7.5% in losses. So what does that give me after 10 trades? So if I minus my total profits from my total losses, at the end of 5 trades, I should be expecting to make a capital gain of 7.5%. Now you'd see that all of this makes sense when you truly understand what you are doing, right? And that's what trading is all about. Trading is actually a business of profit and losses. You become, and that's why they use the word profitable. Profitable doesn't mean you make profits every time, but it means after every transaction or after a series of transactions, when your operational cost or your business cost is being removed from your profits and all those kind of thing expenses, you are still in profit. And that's what trading is. Sometimes you just count your losses as business expense, and this can be tweaked in any way. Different people have different percentages of win rates, but I'm just using the bare minimum to even show you that this can actually work. I mean, even with this 1:2, even with a 40% win rate, you would still be profitable. What would that be? It means that you lose more than you make. So maybe out of every 10 trades, you have 4 wins. Let me put this like this. That's with a 40% win rate system. You have 4 wins. Each wins gives you 3%, right? So 3% multiplied by 4 would give you 12% in profit, right? As opposed your 6 losses, right? So you have 6 losses here of 1.5%, right, times 6, which will give you 9%, right? It gives you 9%. And you see, even when you still now deduct the 12% from the 9%, after 10 trades, you would realize that when you deduct this from this, you realize that you're still in profit of 3%. Although it is significantly small, yes, but I know people with a lesser accurate or win rate that have higher risk to reward, maybe a 1:3, and you see that these numbers tend to increase. So everything all boils down to knowing and understanding the system you trade and knowing what to expect from your outcome, right? That will make you focus more on your inputs and your psychology will be better managed, right? But I'll do a separate video for psychology and trade system and lay more emphasis on risk management. I just wanted to just use this video to explain the importance of lot sizing, leverage, risk management, win rates, and see how everything all makes sense in one, right? So let's go to the next side, bringing it all together. So the formula really for one of the successful ways or best ways to make money from the markets is just about having very good calculated risks, right? Once you have a calculated risk, your lot sizing, and you understand lot sizing very well, it won't be a problem, right? And of course, also having a very good knowledge of leverage, right? And also understanding trading systems. Trading system makes you see the importance of win rates, accuracy, and risk to reward. And also that also helps you filter off some trades. You might see some trade setup that might not give you a good risk to reward. Say if you are looking to target risk to reward ratio of 1:2, and then you see a setup giving you a 1:1, you'll be less interested in taking the setup because you know that your edge really plays on a better or on a fixed risk to reward, right? So that's how it works, and that's what just helps filter many of these things. So thank you for listening and following me to the end, right? If this video has helped you see Forex in a new light, drop a comment and let me know. What's your biggest challenge with lot size or risk management? I would really love to hear about it. And please don't forget to like and subscribe and hit the bell so you never miss a trading tip. See you in the next one. Stay smart and trade safe. Bye guys.